get started, Jon, can you just tell us more about yourself, your origin story, how you found yourself working in the investment industry?
Sure. It's, one of 10,000 similar stories of starting life as a sports writer and winding up being responsible for hundreds of billions of dollars. True story. I actually started as a sports writer. I wound up, the link is I wound up being a press secretary to the New York City Comptroller. So that's one obvious link. What you have to know is the New York City Comptroller is the investment advisor for the 5 New York City pension funds. And there was a bit of a scandal when I was there. It was actually much ado about nothing. We woke up one day to read USA Today, which at the time was a major paper, saying that the comptroller had spoken with Ivan Boesky about the pension funds. Ivan Boesky is probably the most notorious insider trader in the last 50 years. It turns out my boss did nothing wrong, and in fact was one of the few people who had ever gotten a clearance letter for both the New York City, all three, the City Department of Investigations, the district attorney, and the federal U.S. attorney. They don't usually give clearance letters, but he got them. He had done absolutely everything right. But I spent 5 months explaining the pension funds to a bunch of investors. There was a change in administration. Someone asked me if I would do a bunch of pension policy and then ultimately sit on the pension boards. Another change in administration, and the new comptroller asked me if I would run the investments. And so nearly 30 years later, 3 books, being a former Council of Institutional Investors official, an ICGN co-founder, former visiting professor of international finance at Judge Business School in Cambridge. That's the way you do it. You start as a sports writer and you wind up speaking at the Share Conference.
There you go. For the second time, we had you here in 2007 as well. But your origin as a sports writer actually is interesting because your podcast also draws on quite an interesting group of speakers, and that's quite intentional. I understand you ask folks with quite a range of backgrounds to come and talk to the financial community. So, what do you think that's important? Why does the financial community need to hear from people with sort of non-traditional sources of information?
We tend to be pretty insular. Ellen Quigley, who's a PhD at Cambridge, talks about the fact that the more financial education people have, the more asocial they become statistically. We talk to ourselves and it's an insular little bubble, just like and finance isn't any different about this. I mean, if you were, I don't know, a professional hockey player, you talk to other professional hockey players, right? You don't necessarily talk to plumbers and school teachers and other people routinely about their business. You may come into contact with them and I'm sure you're pleasant and have pleasantries. But there's something to be said for learning about things. So I think my favorite recent one, I interviewed a world-class magician about how people get fooled with inattentive blindness and link that to how we tend to fool ourselves about our skill sets in investing and in doing due diligence. So I think there are interesting connections to be made when you open yourself up to thinking about other disciplines and what their strengths and weaknesses are, and then apply them to finance.
Interesting. A magician. That's incredible. We'll have to add that one to our list of podcasts to listen to.
Next week's is crypto, if you're interested.
Okay, there you go. Next week is crypto. I'm sure you'll have many of the folks who are listening now join you. Before we hear more from you about your book, I do want to engage with our audience and put up our first poll, if the tech team can get that up on the platform, and see what our audience thinks about who holds the most power in capital markets. And as that poll is coming up, I just think that question is really at the heart of what we're talking about here today. And that is power. Who holds it? Who wields it? And someone told me once that one of the greatest challenges facing humanity in the 21st century is a concept he referred to as capital supremacy. And he painted the picture of capital sort of as the master, and that all other functions of society should work to reward capital rather than capital being put to work delivering better outcomes for societies. And I think the work that we do at Share really seeks to turn this idea of capital supremacy on its head. But to do that, we really need to understand where the power lies and how to leverage it for change. So let's see what our audience thinks. If we can get perhaps the results up, and if you can share those with me, we can take a look, and then we'll turn the question back to Jon to see what his reflections are on this question. So I can see the poll, and I assume we'll be getting the results here shortly. All right, I can't see the results here, but perhaps they're still coming through. But maybe as we get those, Jon, do you want to jump in and let us know what your perspective is on this?
Sure. I think what's changed about it is the institutionalization of capital markets. And this really isn't appreciated enough. We talk about it, but it really isn't appreciated enough. In 1952, when Harry Markowitz wrote Modern Portfolio Theory, the markets were 8% institutionalized. It is now almost the exact opposite, that it's over 90% institutionalized. And so I think what you see in the results of the poll, which are pretty evenly split with a little more than a third each for asset managers and asset owners, is an understanding that in a capitalist society, when capital is institutionalized and concentrated, it has power. Now, I do think there is a slight benefit to this, particularly, even though it's only by 1 point, that asset owners outpaced asset managers in your poll, that institutionalization has also come with diversification. And that means, as we will get into, that asset owners in particular need to be concerned with the overall economy and the overall levels of market and the environmental, social, and financial systems on which the capital markets rely. Because without that, there is no return. 75 to 94% of your variability return is due to systematic risk factors, not stock picking, which means in some ways that as you become more diversified, you own everything. So it makes less sense to, let me call it, cheat, meaning externalize costs, carbon emissions, or pay workers really nothing, because those costs come back at you in terms of portfolio effects or taxes or the quality of life. So effectively, asset owners are starting to become much more citizen investors. They're much more aligned with the citizenry in general. Issuers, companies, have a non-diversified asset. They care about the company. So if you were only going by economics, they have every incentive to cheat, to externalize costs. I mean, there are moral reasons they don't, there are regulatory reasons they don't, but at least on one level, there is that. And asset managers are somewhere in the middle. So I think that the institutionalization of capital means that those institutions, which are larger, have more power than they used to. they are reined in by government and by a host of civil society institutions. But in some ways, they also are being reined in by the fact that we're starting to see, as Share does, the idea that capital needs to serve society. Society doesn't need to serve capital, at least partially because as diversified asset owners, we are society and we need it to thrive for us to thrive. And so the dichotomy, for instance, that the EU has between double materiality in some way has a feedback loop that comes back to what I would call unified materiality, saying that we need the environmental, social, and financial systems to be strong to have good capital markets, and we need good capital markets to facilitate strong economies and societies.
Great, thank you for that, John. We talked a little bit earlier today about this notion of double materiality, and I like the building on that, this idea of unified materiality. I think that's really, really effective, and we'll delve into that a little further in the conversation. But I want to come back to your book, your most recent book, Moving Beyond Modern Portfolio Theory, Investing That Matters. What brought you to write this book, and what is it trying to achieve?
So the gestation period for this book is longer than any other known gestation period in the world. I didn't realize it was the start of a book, but I guess it was. I had an epiphany more than 25 years ago now when I was running the New York City pension funds. And as you might imagine, that is a bit of a pressurized situation. You're dealing with internal managers and external managers and cash flows from the city and negotiating ISDA agreements and dealing with custodial banks. And I had 5 boards of directors with more than 60 trustees. So you always have a meeting coming up, or in other words, it's a bit of a fire drill where you're running around in place all the time. One afternoon, I had a couple of appointments canceled. I had time to just think. And I had this epiphany that what I really needed was some place to, at that time, we had $80 billion. So I needed some place to put $80 billion to earn a rate of return above inflation forever. That's really what the entire job was, because the money existed for a purpose, to offset pension liabilities. It didn't exist to beat a relative return benchmark. It existed to offset these liabilities. So I had to earn more than the cost of the liabilities forever. And in one way, that was stress reducing, because it's a very clear enunciation of what I have to do. It's not negotiate ISDAs or create investment management agreements or whatever else I was doing that afternoon. On another way, it's a really frightening realization, because modern portfolio theory provides no answer to that. And it provides no answer because it is what we in the investment side of the business call a beta problem, right? The overall risk and return of the market, not an alpha problem where you're trying to beat that risk return through security selection or skill or portfolio construction or whatever. And I really remember that afternoon incredibly clearly. I remember what I was looking at. I remember what I was doing. And so about 5 years ago, I obviously had a career and I was involved in corporate governance. And about 5 years ago, I noticed that corporate governance had changed. We were not dealing as much with executive compensation issues, although we still do. Or I heard Kevin talking earlier about one share, one vote issues. But we also were dealing with things like climate change, mining safety, rights of indigenous people. And I started wondering, there is still a debate, particularly in the United States among some people, as to, is this quote legitimate? And I started thinking about this, and I started realizing that there's actually a unified finance theory around this. which is modern portfolio theory tells you how to extract the best possible return from the existing marketplace. But it tells you nothing about how to improve the risk return of the marketplace in the future. Partially because modern portfolio theory rests on math that seals it off from the real world, right? Efficient market hypothesis assumes everything that's known and is useful. Rationality, which has been disproven, as has EMH, but assumes that people act rationally. Random walk assumes you can't predict the future. All those are wrong, but they serve a useful purpose for modern portfolio theory in that they seal it off from the real world, and so the math works. But the math doesn't take into account things like climate change. And I realized that to deal with that, you have to go into the real world and try to mitigate climate change. You can't do it in the capital markets alone. You have to have, the capital markets affect what assets, clean or dirty, get built, but they're not the assets themselves. And what was happening was, whether you were dealing with apartheid in South Africa, or today, and we should talk about the Ukraine, Russia invading the Ukraine, or climate change or income inequality, these were not one-off political issues that investors were doing, but they were sequential manifestations of trying to mitigate systemic risk, which is risk to the environmental, social, and financial systems, before they created systematic risk, which is non-diversifiable price risk, in the capital markets. So that's what prompted me to make the book, is two epiphanies some 20 years apart.
Great, thanks for that background, Jon. I think it's really interesting thinking about going back to the poll results where we saw asset owners and asset managers together at over 70% in terms of our audience and what they think, where they think power lies in capital markets, and contemplating whether those organizations are ready and are built for purpose in terms of looking at that in improving the marketplace as opposed to improving performance in the portfolio. It seems to me that the investment world and most of investment committees and trustees, the place they live is built on stock selection and portfolio construction. But what I'm hearing from you is those tools aren't sufficient. And so what are the navigation aids or guideposts in the investment paradigm, that you're suggesting? How do we ensure we're not sort of casting asset owners adrift?
Right. So let me first provide a little context here. Depending on which academic study you look at, 75 to 94% of your return is due to overall market factors. It's not due to security selection. People say the purpose of asset management is to create the optimal risk-adjusted return. They never say the optimal alpha risk-adjusted return, right? If you're offsetting a liability, if the market's down 10% and you're down 8%, you've outperformed, but you have 92 cents on the dollar to offset your liabilities, right? Similarly, if you're investing for a purpose, there's an argument of why, if you could fulfill that at a lower risk, do you chase returns at a higher risk if you can increase your probability of offsetting your liabilities at a lower risk? And that was one of the reasons that led to the global financial crisis, was that everyone kept on chasing higher and higher returns and not looking at what was underlying them. So this is a financial book, and you are better able to fulfill your obligations to your beneficiaries, particularly if you're a pension fund, or if you're an insurance company, or even if it's just an individual thinking about liabilities in terms of saving for retirement, when you have robust capital markets. I mean, it was really hard to lose money last year, right? I mean, you know, I don't care how good you were the first 2 months of this year, you didn't match the 2 month return last year, just evidence of the market driving the vast majority of returns. What you want to do is you want to have a robust capital market that you can then apply those stock selection and portfolio construction tools to, so that in effect, you're applying your tools to a higher re-rated capital market. How do you do that? I think there are a set of tools that deal with going into the real world. You form coalitions like Canadian Coalition on Good Governance, like PRI. You educate yourself on what campaigns are out there. I mean, Share itself, for instance, is doing a modern slavery initiative. And I note that the tool there is you try to get legislation. Well, polity is a major tool, or the Investors for Opioid and Pharmaceutical Accountability, which I want to mention specifically because we tend to think of things either at an individual company or a legislative fix for everything. And a lot of systemic risks are at the industry level, because all the companies in the industry are exposed to the same thing. And you can often get the responsible companies in an industry to work alongside you. So for instance, the Investor Mining and Tailing Initiative, which is led by the Church of England commissioners and the AP funded in Sweden, is dealing with mining safety after the Brazil collapse that killed more than 250 people. And a lot of mining facilities are on remote ground, often inhabited by indigenous people. And so bringing the industry up to speed so that they have guardrails, so they're not worried about a single player in the industry having a race to the bottom, is helpful. You know, climate change is the obvious one. And there's the new Canadian initiative that's patterned after Climate Action 100. So coalitions, engagement, polity. I think there are a couple of really good resources for people who want to do more. Excuse me. I just helped a pension plan that will go unnamed at the moment rewrite their statement of investment beliefs to deal with these issues so that the entire organization, from trustees to investment staff to internal management to external management, understood what the pension fund was trying to accomplish. Disclosure, I'm on the board of the Shareholder Commons. I don't always agree with everything it does, but it does really good work in this area. It's been working, for instance, with HESTA, the Australian Superannuation Association, on issues of antimicrobial resistance. TIP, the Investment Integration Project, the two founders of that, Bill Burkhart and Steve Leidenberg, have a great book out called 21st Century Investing, which has some of the tools that they have 10 tools of intentionality and a 6-step method for applying them that I would recommend to anyone who wants to really dig into how to do it. But what I find is before you can deal with how to do it, you have to deal with why you should do it, because there are still people who think that the capital markets somehow exist apart and separate from the real world, as opposed to serve the real world. And I'd like to just take a minute to underline the headlines of the last few days that show just how false an idea it is to seal off the capital market and say, well, these aren't investing issues, these are political issues. You know, I don't in any way want to minimize the suffering that's going on in the Ukraine right now by talking about finance, but the reality is we're fighting back by weaponizing finance, right? We're judging how well we do by what's the ruble doing. we're looking at what are the effects on the economy of the real world by what's the price of oil? Have safe haven assets risen? Where the ETF providers to Russian stocks have shut off create units. And so the idea that finance and the real world are separated somehow has to be dealt with. And you have to convince that we talked earlier about being an unusual background and looking from the outside in. People who have only been taught the math of MPT have to understand how hermetically sealed that math is from the real world. The only link, and it's a fairly tenuous, slim read to base it all on, is price. They have to understand that if there's a peaceful solution in the Ukraine, markets are going to go up. I don't think anyone would disagree with that. And if this continues, there's extra risk in the world. And so going into the real world and mitigating risk is good for markets and is good for your long-term return, as well as hopefully saving some lives and saving the planet. Sorry to say that, but it's hard to have this conversation today with that as the news background without talking about it.
No, absolutely. I'm glad you brought it up. And I think we're all watching and being mindful of the horrendous suffering that's happening in the Ukraine as a result of the Russian invasion, but also watching with great interest the reactions in financial markets and capital markets. And you touched on this, but I want to just sort of ask you to delve a little bit further into it in terms of when you're seeing this, what you call the weaponization of finance. What does it reveal to you about the potential of capital markets, the potential of the financial system in addressing other types of systemic risks? And what does that show to some of the audience who are, in many circumstances are being told that this isn't possible, or that's out of the realm of what we can do, or things like that?
Well, it's clearly possible. The book details it and actually quantifies some of the things. For instance, New York City's proxy boardroom access project, which changes how companies in the United States can nominate directors, has created billions in value. But I think what the Ukraine situation says is somehow when there is a crisis in the world, even those who think that you can't do this or you shouldn't do this, do it. And I don't want to say everything is a legitimate systemic risk, but clearly war is a legitimate systemic risk. And so to the extent that you are dealing with systemic risks like climate change or income inequality, diversity initiatives, going into the real world and mitigating them is really good financial strategy. And by the way, it's cheap. I mean, I'm always amazed that people go, well, you shouldn't be spending assets on that. And I'm sitting there going, we estimate you should be spending about, because of where this has actually mitigated risk previously, if you spent a half of 1% of your assets on it, and obviously that's a very rough rule of thumb because there's a step function. And if you're a very large pension fund, you don't have to spend that much on this. And writing a letter to a legislator doesn't take a lot of money. You have to vote your proxies anyway. Voting them in an informed manner doesn't take a lot of money. Engaging with companies takes a little more money, but signing on to a letter or a CCGG initiative or a PRI initiative at a particular company doesn't take a lot of money. I think what does take some time and effort is to figure out what are the issues your institution wants to focus on and what your unique skill set is. So for instance, if you have a large private equity investment, are they skilled enough to find clean tech opportunities? If you are a government pension fund, do you want to engage with government on polity? If you have a board of citizen educators, as a lot of teacher and university funds do, is there research that you should be spreading around that makes this point of view known more? So I don't think it's expensive. I think there are ways to do it. I've mentioned some of the resources, and I'd be glad to talk to anyone else about more. The first thing to do, though, is to talk to the people who are the ultimate fiduciaries for your plan to say, look, we've got to break out of this idea that we invest in capital markets solely by picking securities. The fact of the matter is we get buffeted by capital markets. The MPT paradox is that MPT claims that your investments are affected by the markets, but your investments don't affect the markets. It's a one-way valve, and that's just wrong. Risk on, risk off markets are people affecting the market. Index effects are people affecting the markets. The trick is, let's do it with intentionality around systemic risk and try to mitigate systemic risk.
That's great. Thank you. I hope that the investment beliefs that you helped work on at some point that becomes a public document, because I'm also a big believer in investment beliefs being sort of the foundation of intentionality, actually, and the foundation of directing the way in which asset owners then go about hiring, overseeing, and directing the various service providers that work with them. I want to go back to your book, and chapter 5 of your book references what you call the third stage of corporate governance. Can you tell us a little bit more about that? What are some of the key characteristics of that, the third stage, and the relevance to investors?
Sure. Let me do 350 years of corporate governance in 5 minutes or less. The first modern corporation was probably the Dutch East India Company in 1602. For those of you who have never read the history, it's fascinating. I mean, if you were a novelist, you couldn't have foreshadowed the themes of modern corporate governance as well as they did. Executive compensation. There were complaints at the time that insiders got rich in the manner of mushrooms, meaning in the dark and growing rapidly. There was power. There was a famous fight with one of the investors, Isaac Lemaire, who actually then became the world's first short seller to try and affect the Dutch East India. There were environmental and social issues. The VOC, as the Dutch East India Company is known in Dutch, enforced its trading with a bunch of piracy and slavery. That didn't go over very well with the Dutch Protestant society. So not a there were environmental and social matters. There was capital structure issues. This was the first time capital was ever taken permanently, and Lemaire and others objected, and the company finally agreed to pay them dividends. But in fact, in another foreshadowing, the company got smart, and after a while of paying them in Dutch guilders, they said, well, we've had enough with paying you real dividends. We'll pay you in nutmeg, right, and black pepper. And let's call that stage 0 of corporate governance. And not everything was the same, but the standard was set for about 350 years. Management ruled, right? Because that was the central. We talked about power before. They had the power. These were all retail shareholders. They were an institution with the implicit backing of the Dutch government, done whatever they wanted. And while things changed a little bit, it basically stayed the same for 350 years. So we get to stage one in the 1980s. And I'm going to detail this more from the US point of view because I'm American, so I know it better, but it was paralleled elsewhere in the world. Various things had started the institutionalization of capital, ERISA law in the US, for instance. But people didn't quite realize that. And the 1980s was this very strange, almost dystopian world in which greenmail occurred. Greenmail, for those of you too young to remember, was the equivalent of blackmail, or perhaps in today's world, a cyber ransom attack. And a greenmailer would take a stake in a company and threaten the nice ensconced world of the CEO and said, we're going to have a hostile takeover unless you buy back our shares at a premium to the market. And this was a big deal. I mean, this was common. Sir James Goldsmith got $93 million from Goodyear Tire and Rubber. Saul Steinberg at Walt Disney. In 1 year, ended April 1984, greenmailers in the United States extracted $4 billion from US public companies. That was 1984, and that is not an inflation-adjusted number. And so the greenmailers were happy and rich. The CEOs were happy. They were back in charge. And the only people that got, I'll use the polite word, disadvantaged were we shareholders, right? And a couple of people got upset, primarily Jess Unruh, who was the treasurer of the state of California, Roland Mackel from New Jersey, and my boss at the time, Harrison Golden, in New York, and they formed the Council of Institutional Investors. The Council of Institutional Investors said, this just isn't right, and had a Bill of Rights. And let me tell you how radical this was. I actually have this quote permanently on my wall, so I can read it. This is from the Washington Post, right? And this is how weird the idea that shareholders actually had any rights were. And the front page of the Washington Post, kings of corporate management beware. Your once loyal and passive subjects have declared their independence by adopting the Shareholder Bill of Rights. No longer will your biggest stockholders stand idly by as you take away their right to vote on questions as crucial as who will rule the corporate kingdom. Gone are the days when shareholders will watch silently as top executives adopt anti-takeover devices that entrench management and depress stock prices. So that was stage one. And it really was this weird dystopian universe. I mean, we had Pac-Man defenses and white knights and dead hand pills and poison pills, but the sides sort of started to engage. And so when shareholders who now had some money, they were institutionalized, started fighting back on roughly equal grounds. We call that stage one, from like 1985 to about 2005. And what happened in 2005 was Kofi Annan, the UN Secretary General, invited 20 global investors together. They created what at that time was the United Nations Principles for Responsible Investment. And so you had the E and the S added to the G. Now, there had been E and S action before. Anti-apartheid activism was perhaps the most muscular flexing of shareholder muscle up to that point. And the series principles had already been written. They were actually initially the Valdez principles after the Exxon Valdez that crashed into Prince William Sound. But PRI clearly brought about a more holistic vision of value, but it was still focused on individual companies. Shortly after PRI, though, in 2008, 2009, you had the global financial crisis, and investors and everyone else started wondering what went wrong and understanding that we had to shoulder some of the blame, but that there were systemic risks that impacted the market. And that sort of led to stage three. And stage three builds on stage one and two, because stage two, the PRI, was still dealing with individual companies. You know, there's a famous saying from Dale Hansen, who was the CEO of CalPERS, that they were trying to get the herd to run faster. through corporate governance. But the way they did that was we were picking off the slow zebras. We weren't giving the herd vitamins or something, right? Stage 3 tries to give everyone vitamins, and it has stewardship activities that target systemic risks. So climate change, racial justice issues, income inequality, industry groups like IOPA that Sheriff clearly knows, or the Minings Initiative, or the New Zealand Superannuation Fund trustees have been dealing with the major tech firms to decrease their inadvertent, I would say, promoting of terror following the Christchurch shootings. So people are looking systemically. Antimicrobial resistance is another one, at what they can do. And they're now, you may be targeting companies. For instance, the Canadian environmental effort targets companies, but they target it based on a systemic risk, right? It's not targeting the company for its financial return as in stage 1, or even the way stage 2 did. So that's why we say stage 3. And what's also happening is a broadening of the tool set to include things like policy influence, partnerships. And so that's where stage 3 is.
Well, that was pretty good. You did it in 6 minutes, 350
6 minutes?
years.
I'm sorry, I was a minute over.
It's okay. I would tell you I'd give you an extra minute, so it's all good. But it's interesting. One of the things, the session before this session earlier today, we had a campaign spotlight look at the efforts to take the Bangladesh Accord for worker health and safety and move that into an international accord, which is really, it's not polity, it's not policy, but it is a binding mechanism that's really looking at addressing systemic worker health and safety issues in the garment sector around the world. And so I think it's another great example. How do we get brands to come on board, and that standard and that mechanism and the due diligence associated with it becomes a market norm?
Well, it's actually my favorite tool, which is standard setting. And if you think about it, that is what, whatever you may think of BlackRock, when Larry Fink says 2 years ago, dear CEOs, we'd like you to report according to SASB and TCFD. That is private sector standard setting. It's saying this is how we would like you to report. There's no regulatory requirement that you do so, but you know what? The reporting jumped up. And so if you get enough power behind the Bangladesh Accord, you create a private sector standard. In some ways, that's what public shaming through divestiture does. I mean, it says, and I'm not a huge divestiture fan. I think it's overused. I think it's a legitimate tool, but it's overused. That these things are just so far beyond the pale that we're going to say this is our standard, and we're going to hold you to a standard to participate in the capital markets.
Yeah, absolutely. And I think it goes back to your comment around intentionality, and knowing, where that line is, where that a stick exists, I guess, in some ways is actually really, really important as we talk about the expectations with regards to decarbonization, with regards to how companies and business models are transitioning. I want to first sort of remind the audience that we are going to have time for questions, and you can start putting those through the question and answer box, which is located on the Chime platform. So please feel free to start putting some questions in there. I did want to go back to the question of power, Jon, with you before we turn to the audience for some questions. In your story of the 350 years of power, you sort of touch on this reference to managerial power, and I've heard you speak about this before. And in your book, you talk about doing an interview with a CEO candidate. for a company, and in that interview, the candidate had stated, quote, "I'll be damned if I have someone looking over my shoulder as I run my company." I work with several investment committees and governing boards of pension funds, and much of the audience here today are trustees and investment committee members. And I was struck by the similarity between your description, in this case, of managerial power, and some of the stories that I hear from some of the boards that I work with. Around their experiences working with their asset managers. And the managerial power in this sense, I think, is slightly more muted. And I'm not sure if that is a Canadian thing and a dynamic in the industry itself and in the relationship between asset owners and their managers. But, we do hear from people that they've been told, for example, don't worry about that. And I could almost put in the word sweetheart, because this was, of course, a woman who was being put in her place. Don't worry about that. We have it under control. And so it strikes me that there is a similarity here. And based on your experience dealing with this sort of in the corporate boardroom and the dynamic between the corporate boardroom and shareholders, do you have any advice for those who are playing governing roles on asset owner boards when they face this kind of managerial power?
Yeah, I've dealt with it on asset owner boards, on pension boards as well. First, I just have to say, I am so glad you're talking about power. Just a very brief story is I was a guest lecturer at Career University, and Ira Milstein, a very famous U.S. corporate lawyer, and Ann Simpson, who I'm sure many of you know from her time both at the ICJ and then CalPERS, although she's recently going to the private sector, were speaking, and I was sort of invited to tag along with them. And after they spoke, I'm sitting there going, what am I going to talk about? They've already done it. And I said, let me tell you what Ira and Ann didn't say. This is about power, right? It's about who has power, who exercises power, when, how effectively, and how legitimately. So I'm very glad you're talking about power. What you're saying from the managers is not even power, because you guys hire them and can fire them, but they are taking advantage of information asymmetry to make it seem like they are smarter or more powerful than you are. I am actually working on writing a corporate governance paper for COSO. And we've been trying to deal with this issue. How does a board deal with information asymmetry with the executives who know more about the company than they ever will, right? And I think the answer is something called constructive challenge. And constructive challenge is asking questions of the managers, whether it's an investment manager or a CEO, respectfully, but hard questions to make them prove that they have done the due diligence to support the answer that they have, and that they have considered the options that you are proposing to them. So asking, I understand that you say that you only invest in gold mining operations that have high environmental standards. Can you tell me how you know that? Have they signed on to any accords? Are they members of the Investor Mining and Tailing Initiative? Do they report the location of their tailing ponds? How are they constructed? Right? You have to be informed to ask all those questions, but some of them you don't have to be, but you should be informed to ask the questions. But it's a constructive challenge. It's not saying you didn't do your job. It's saying, these are the levels of due diligence that I want so that I can trust you when you say, don't worry about it. Please don't say sweetheart, because that's really annoying. But when you say, don't worry about it. And constructive challenge is useful in holding your managers to account. The other thing is, at some point, I would have taken that manager aside, perhaps privately the first time, and say, excuse me, I'm not a 3-year-old and you're not my parent. Don't worry about it is not a good enough answer. It's a little akin to saying, because I said so. So I would expect a more fulsome answer in the future, please. Right? There may be no monsters under my bed, but you're not my mother, and I don't take that anymore. I also think if you don't do constructive challenge, and I have seen this happen, you abdicate your fiduciary obligation. How do you know the manager is fulfilling the job? You need to do your due diligence, and constructive challenge does that. To the extent that you're not getting reports that you want to get, change your IMA. You've hired them. Change your investment management agreement, right? And ask about how the managers vote, how they engage. Most managers nowadays provide a stewardship report. Now, no one provides a bad stewardship report. They all make them look good. So the question, you can ask questions about them though. Again, constructive challenge. Why did you choose these companies to engage with? How did you choose the issues to engage with? How large is your stewardship team? How many companies did you engage with? A little math. Oh, so that means you had 14 engagements per person or 1,400. There's a difference qualitatively, obviously. So I think there are tools available for trustees to, within the bounds of that relationship, actually improve the relationship. There was the famous expression, trust but verify, which actually is taken from an old Russian statement. But the Russian statement was verify, then trust, because the verification that comes from the constructive challenge is in fact what enables you to trust. If you trust then verify, you assume that verification will come later, and it may either never come or be too late, or it may betray your trust. So verify, then trust, and the way to do that is with constructive challenge.
Thanks, Jon. That's hugely helpful. I do think it is challenging. You mentioned sort of what do sufficient resources look like towards some of these issues, including engagement, including sort of the ESG teams, and that's a tough one. That's a tough one that I think folks are really grappling with in terms of how do we ensure that our managers are really devoting sufficient resources to these issues. So I think that's certainly an ongoing challenge. And if you have any ideas of how to gauge that, and the audience would be, and myself would be really interested in understanding that.
I would also ask what the reporting lines are. If the ESG person is 4 lines down and reporting to compliance, that's not a stewardship. That's a compliance, right? There is, I don't want to endorse a particular firm, but there's a UK-based firm active in the US and Canada, where the head of stewardship is literally on the board reporting to the CEO. Mm-hmm. And it's not an accident that firm has a very good reputation for its stewardship activities.
Yeah, I also will call out the Brune Pension Partnership, because I've always been very impressed with the work that they're doing in this space, and the fact that Faith Ward is a Chief Responsible Investment Officer. So she's right up there, high up in the organization, and clearly the organization is putting some serious resources towards that. I want to go into some of the questions through from the audience. So the first question here is from Doug Olthius, and he's talking about going into the real world will mitigate risk, but if others are doing it anyway, can't we rely on them to push forward the risk mitigation? So I think my interpretation of the question is, if other people are doing it anyway, can't we free ride? In a sense, is how I interpret that question.
Oh God, there's so many ways to answer this. I mean, the obvious, the snide answer is, are they doing it? Right. But the better answer, I think, is twofold. One, we just talk about constructive challenge, in effect by investors challenging civil society institutions and government, you make sure they're doing their job. The other question is, we're talking about power. Why would you cede power? You know that issuers who are single interest entities are going to do this around tax policy, around trade policy. Why would you not want your voice to be heard? And the last is, there's just, I think, and I'm sorry, here I will get into moral imperative. Pension funds exist for a social purpose. There is what in economic theory we've identified as extended risk, extended intermediation. Your beneficiaries are going to be expending the current cash flows sometime in the future. Why would you not want to use every tool you have available to make sure they expend them in a regime that is healthy for them? What I mean by that is, let's take income inequality. Mm-hmm. If we do nothing about income inequality, and someone who retires 30 years from now has to live in a gated armed community, or even worse, live outside the gated armed community looking in, mm-hmm. What's the discount rate for that? I don't know it. I don't think anyone knows it. And so expending a little bit now to say to government, we have to do something about this, to deal with these issues on the ground, I think is a valid and fiduciarily responsible way to think about the purpose for which pension funds are created.
Thanks, Jon. Just to follow up on that, one of the things that I hear often before going to the next question from Peter Chapman. I know. So let's go to the next question.
No, we can answer. Go ahead.
No. I want to, because I want to make sure to address it, because it is a great question. And as I said, from our founding executive director, Peter Chapman, who is in the audience. So do regulators, both securities regulators and pension regulators, need to catch up with stage 3 corporate governance?
Yes.
Yes. All right.
So here's the rub, and the OSC is in the same place, but I'm going to use the American example just because I know it better. So the Supreme Court has defined materiality as that which a reasonable investor would want to have as part of the totality of information to make an investment decision. What hasn't kept up is, I talked earlier about the change in the capital markets. If you invest through an index fund or through a diversified portfolio, what happens to the capital market overall matters to you at least as much as what happens to an individual company. And yet all of our materiality disclosures are based as if you are thinking about only what happens to the individual company. And my question, or what is called outside-in materiality, right? What the EU calls financial materiality, and not what that company does to the capital markets, or inside-out materiality. And so my question is, if regulation is based on what a reasonable investor would need, and the nature of a reasonable investor has changed from someone who picks, I'm going to invest in stock XYZ, to someone who says, I'm going to invest in the TSX or the S&P 500 or the ACWI, doesn't that change the information that they need? And my answer is yes, it does. And I don't believe that change from the idea of an individual investor sitting, poring over what then were, newspaper tabs and annual reports in physical form, has, in the mid 20th century, has caught up to where we are a fifth of the way through the 21st century, where we're investing in ETFs and index funds and looking at what the companies are doing to the capital markets as well, and to the systems, as well as what the systems are doing to the company. So I think it's a great question. And what needs to change is the mindset that says we have to have investor protection for diversified investors as well as for investors who stock pick an individual company.
Great, thanks. So we still have time for some more questions. So I encourage the audience to keep putting them into the Q&A box. The question that I had for you, Jon, following up on both of these points, actually is something that I hear often, and I understand it. And it's, we're small, and in fact, people's perception of whether they're a small asset owner or a large asset owner is actually, quite interesting. It ranges, and so there's not much we do. What would your piece of advice be to those asset owners who aren't sort of the big players? They're not the big public sector pension plans, but they fall beneath that sort of threshold.
Yeah, the problem with presentations like this is always you sort of elide over things. And I said before, the hard thing was figuring out what your unique strength and skill set is. So if you're small, you may have a passion for a particular thing. So Domini is a socially responsible investment manager in the US that has, I don't want to get it wrong, but I think it's about $2 billion total. And what they have decided is that they are going to focus on deforestation. And they have sponsored research on it and thought papers on it. They were the lead in a coalition to try and pass a bill about it in California. And so they deliberately constrained their focus to try to make an effort on one issue that they cared passionately about. I think that is one strategy. The other strategy, if you're small, is to form coalitions, join PRI, work through SHARE, work through CCGG. If you want to, join ICGN, so that free rider issue is spread over a larger cost base. And just having a name attached sometimes to a sign-on letter is really useful. But think about what you're passionate about, what you're uniquely skilled at, and there will be something. You don't have to, I sometimes take pleasure in some of the old wisdom of you don't have to solve the world's problems, but that doesn't obviate you from trying to do what you can do. So don't let perfect be the enemy of better.
Absolutely. So we have just a few minutes left, Jon. We have one question here from the SHARE team around, if you're a trustee on a board, what can you do pragmatically to press your fund to respond to social systemic risks like inequality?
Well, ultimately, that's the decision of the fiduciary of what you want to focus on. I think you can't focus on everything. You have to pick 2, 3, 4, pick your number. And what you can do is you can actually run a process in which you have one-on-one conversations or a poll or whatever with the board and with senior management, say which issues are of import to you, and try and sort of rank order them, and then have a discussion that has people reach a consensus. So I think that is a good process that helps people feel they are being heard and has a discussion about the various issues that the board would want to take on.
Great. So I want to give you a chance for some closing remarks, Jon, and looking at reflecting back on your book, Moving Beyond Modern Portfolio Theory. What is the takeaway? What, the Share Investor Summit, we like to say that We pride ourselves on being action oriented. So we really do want to drive action by the folks who are in the audience, and be able to take practical things away. So if there was one thing you wanted to leave the audience with today, what would that be?
I think the nice thing about the book is it is the first time there is a unified finance theory as opposed to a political or people and planet theory and reason to engage in trying to mitigate issues like lack of diversity, income inequality, climate change. And that there is the need to further spread that message to educate managers and particularly consultants, which we haven't talked about, which are sometimes more of a stumbling block than managers, about this. And that you can fulfill your fiduciary obligation by increasing the overall risk return of the market, not just by trying to beat the market. I was very pleased to hear from a Canadian Pension Trust Board trustee recently who had been on a Canadian pension fund, been off for 5 years, and 2 years ago went back on, that their fiduciary counsel told her that they had to consider climate change or be at risk of their fiduciary duty. She said 5 years ago, she had received the exact opposite advice. And so change is coming. Things do progress. In the words of Martin Luther King, the moral arc of the universe is long, but bends towards justice. And I think the thing that we can do is bend it a little faster and a little farther.
Excellent. Well, I think that's the best note to leave us on, Jon. Thank you for joining us.
Thank you so much for inviting me.
And I
wish
did
it were
have fun.
Vancouver, but...
We will bring you to Vancouver. And you don't, if you write a book, but you won't need to write a book. We'll find a reason to have you back in person. It was really fun talking to you, Jon. I really appreciate it. And we will hand it back to Katie to close us off.